Most traders dream of the big win. They imagine that one breakthrough moment where everything changes, where the market rewards them for their belief, their confidence, or their courage. But trading doesn't work that way. And the market has never promised such things. The market only reflects your behavior, your mindset, your discipline, and your ability to execute without emotional interference. And the most powerful shift a trader can make begins not with trying to win big, but with learning to start small. Because starting small is not about limiting your potential. It's about expanding your capacity to think clearly, act consistently, and build the psychological foundation required for long-term success. When you start small, you remove the psychological pressure that forces you into irrational decisions. You aren't trading to prove anything. You aren't trading to compensate for a loss. You aren't chasing an identity or a fantasy. You're trading to develop skills, internal stability, and emotional neutrality. This is the space where a trader begins to understand that consistency is not born from intensity, but from clarity. And clarity only comes when the mind is free from the fear of losing or the need to win. A small position size gives you that freedom. And with freedom comes the ability to see the market as it is, not as you want it to be. Most traders underestimate how deeply their beliefs influence their actions. When the stakes feel high, those beliefs rise to the surface. Fear, greed, hesitation, hope, they all distort your perception of opportunity and risk. Starting small exposes those emotions without letting them destroy you. It creates a controlled environment where you can watch your own psychological patterns unfold while the financial consequences remain minimal. You start to notice the subtle moments when you tighten up, when you hesitate to exit, when you rush into a trade because it feels right, or when you sabotage yourself because you're trying too hard to get somewhere fast. Small positions allow you to study these moments with accuracy, and only then can you work on them. Starting small also teaches you the truth about probabilities. It forces you to accept that each trade is independent, each outcome uncertain, and each moment an opportunity for alignment rather than prediction. You begin to operate from a mindset where execution matters more than outcome, where following your plan becomes more important than the temporary pleasure of a winning trade. And as this mindset strengthens, something subtle but powerful shifts. You start acting like a consistent trader before you ever achieve consistent results. That transformation is what eventually leads to winning big. Not through force, but through evolution. Every trader says they want big results, but few are willing to adopt the process that creates them. Starting small is that process. It's the training ground where you build the emotional resilience, the disciplined thinking, and the neutral mindset that the market demands. Once these internal structures are in place, scaling up becomes a natural extension of who you've become, not a leap into uncertainty. Starting small to reduce emotional pressure and gain clarity in decision-making is the foundation on which real trading mastery is built. Most traders underestimate how much emotional weight they place on every trade, especially when they trade large relative to their account size or their psychological tolerance. When the position is big, everything inside you becomes magnified. Fear feels heavier, greed feels louder, hesitation becomes sharper, doubt becomes paralyzing, and this emotional intensity doesn't make you better, it dismantles your ability to see the market clearly. Starting small removes that unnecessary burden. It gives your mind room to breathe, to observe, to process, to respond instead of react. When the risk feels manageable, your thoughts become more structured, your actions become more intentional, and your judgment becomes more accurate. When you reduce size, you also reduce the internal chatter that clouds your analysis. Every trader knows what it feels like to see a setup clearly when they're out of the market, but suddenly lose that clarity the moment real money is on the line. That shift happens because your brain switches from analysis to survival mode. Big risk automatically triggers defensive emotions, and defensive emotions distort perception. With small size, your brain does not enter that heightened survival response. You're no longer attached to the outcome of a single trade, so you can actually see what the chart is telling you, rather than projecting your hopes or fears onto it. This clarity is what allows you to identify real opportunities instead of imagined ones. Small size also sharpens your ability to follow rules. When the emotional pressure is low, your discipline naturally improves. You become more willing to wait for confirmation instead of jumping in early. You become more willing to accept your stop loss instead of moving it. You become more consistent at taking profit where your plan tells you to instead of holding out for more because greed whispers that it's possible. Many traders think they have discipline problems, but in reality, they have size problems. Their discipline collapses under emotional load. When the size is small, the emotional load decreases and the true behavior of a disciplined trader begins to emerge. Starting small gives you a psychological environment where mistakes don't cost you mental stability. When the consequences are minor, you can be honest with yourself. You can look at your errors without becoming defensive, without rushing to justify them, without spiraling into frustration. You can analyze what went wrong with calmness instead of self-criticism. This honest feedback loop is crucial because traders grow only when they confront their patterns without emotional punishment. Small size allows you to stay neutral enough to observe those patterns with precision. Clarity is not only about technical understanding, it's also about mental quietness. When you are not overwhelmed by fear of loss, you can hear your intuition more clearly. You can sense when a pattern aligns, when momentum shifts, when market context confirms your setup. Many traders think they lack intuition, but what they truly lack is mental space. Their intuition is buried under layers of tension and overthinking. With small trades, intuition resurfaces because your mind is not fighting itself. You're not negotiating with fear or battling with impulses. You're simply watching and responding. This state is where your trading becomes fluid and natural. Starting small also lets you build trust with yourself. Trust is one of the most underrated components of trading psychology. If you don't trust yourself to act correctly under pressure, you will sabotage your best setups and overtrade mediocre ones. You will close winners too early and hold losers too long. But when you trade small, you give yourself a setting where it's safe to practice being consistent. You execute your plan, you follow your rules, and you prove to yourself, trade by trade, that you can be reliable. This creates a positive internal identity, the identity of someone who can follow through. Once this identity is strong, scaling up does not break your discipline because your actions are grounded in internal stability, not in fear-driven reactions. Another powerful effect of starting small is that it exposes the illusions you carry about the market. When traders trade large, they tend to believe the market is the problem. They think volatility is the reason they panicked, or that a sudden pullback is the reason they acted irrationally. But small trades reveal the truth. The psychological discomfort didn't come from the market, it came from the size. You begin to see that the chart hasn't changed. It's your internal state that changes with your risk. This realization frees you from the tendency to blame external factors and makes you responsible for your decisions, which is the only place real growth happens. Starting small also allows you to experience the market as a series of probabilities instead of outcomes you're emotionally attached to. When the position is tiny, your focus shifts from "I have to win" to "I have to execute correctly." This shift is the core of professional level thinking. You start giving less importance to individual trades and more importance to the process. You understand that your job is not to win this trade, but to perform your edge repeatedly without psychological interference. This mindset can only be developed when pressure is low, and nothing reduces pressure like small size. With small size, you learn how to wait. You don't feel compelled to force trades. You become patient because the urgency disappears. The market becomes something you observe rather than chase. You learn to act only when the market gives you a reason to act. Patience is born from the absence of pressure, and small size is the simplest way to create that environment. Small size is not a tactic. It's a psychological training ground. It's where you refine your emotional control, sharpen your clarity, stabilize your thought process, and strengthen your ability to remain neutral. It's where you learn the truth about yourself as a trader without the noise of fear and without the weight of expectations. Small positions reveal psychological patterns without heavy financial consequences. And this insight is one of the most powerful tools a trader can develop. Many traders enter the markets believing that success is measured solely by profits or account growth, but in reality, trading is primarily a reflection of the inner world. Every action you take in the market, when you enter, when you exit, how you manage risk, is driven by a combination of beliefs, emotions, and subconscious patterns that you may not even be aware of. Large positions magnify the stakes so dramatically that these patterns are often disguised by stress, fear, or greed. You don't truly see yourself when the pressure is too high. You see only a distorted version filtered through emotional intensity. Small positions, however, act like a psychological magnifying glass, allowing you to observe your true behavior without the distortions of high risk. When you trade small, you gain an extraordinary opportunity to study your responses in real time. Every hesitation, every impulsive move, every deviation from your plan becomes noticeable because the consequences are manageable. For example, you might notice that you enter a trade too early out of impatience, or that you exit too quickly out of fear. These reactions, if magnified by large size, could lead to catastrophic losses, but when your exposure is small, you have the clarity to see them as patterns rather than crises. This is where true learning occurs. When you can dissect your own behavior calmly and objectively without the pressure to justify yourself or make up for lost capital. Small size also reveals your tendencies toward emotional trading. Fear and greed are the two most obvious drivers, but subtler forces like hope, frustration, and overconfidence also shape your decisions. You might notice, for instance, that you tighten your stops unnecessarily when a trade goes against you, or that you chase a trend too late because you're afraid of missing out. These tendencies are often invisible when every trade feels like life or death, but small positions make them visible. You start to recognize patterns that repeat in different market conditions and across different instruments, and this self-awareness is the foundation of behavioral mastery. One of the most valuable aspects of small trading is that it allows you to test your rules and strategies in a low-pressure environment. You begin to see which parts of your plan you follow consistently and which parts you tend to bend or ignore under stress. For instance, you may have a rule about cutting losses at a certain level, but in practice you notice that even with small positions, you hesitate. Recognizing this pattern without catastrophic consequences gives you the chance to understand the psychological reasoning behind it. Perhaps it's tied to ego, past losses, or a fear of being wrong. Small trades illuminate these underlying drivers so you can address them consciously. Another important effect of small positions is the way they build confidence and reinforce learning. When you observe your behavior without the burden of high stakes, you start to internalize what works and what doesn't. You build a mental library of experiences that inform future decisions. You see how patience leads to better entries, how discipline preserves capital, and how emotion-driven decisions erode consistency. Over time, these insights create a feedback loop. You execute, observe, learn, adjust, and reinforce positive behaviors. This is far more valuable than winning a single large trade because it strengthens your long-term ability to act rationally and consistently. Small positions also highlight the difference between market behavior and your own projections. Many traders confuse the unpredictability of the market with a failure in themselves. They assume that a loss or a drawdown reflects incompetence or lack of skill. Trading small helps disentangle this confusion. When the financial impact is minor, you can examine whether a trade failed because of your execution or because of natural market variability. This distinction is crucial because it teaches you to separate process from outcome. You learn that consistent adherence to your strategy is what matters, and that short-term results are largely a reflection of probabilities and randomness. Additionally, trading small exposes your mental weaknesses without punishing your account. You may discover that you have a tendency to overtrade after a small loss, or that you hesitate to enter positions despite clear setups. Small positions allow you to test corrective measures in a safe environment. You can consciously implement discipline, observe the results, and refine your behavior. Over time, these small behavioral adjustments accumulate into substantial psychological resilience. The market becomes a mirror of your mind rather than a source of stress or ego validation. Small trading also nurtures emotional neutrality. When your exposure is limited, you no longer attach your self-worth to individual trades. You learn to observe without reacting, to execute without attachment, and to assess situations with objectivity. This state of emotional neutrality is essential for long-term success. It enables you to respond to market conditions rather than react impulsively. Patterns in your behavior emerge not as crises, but as opportunities for self-correction, and the feedback you receive from each trade becomes constructive rather than punitive. The discipline gained through small trading eventually scales naturally. Once you understand your psychological patterns and how they influence your decisions, you can begin to increase position sizes without losing control. The patterns that small trades reveal are consistent across size, so the same behaviors that are manageable at low risk will either reinforce strength or expose weaknesses at higher risk. By starting small, you build a foundation of self-awareness, discipline, and emotional intelligence that allows you to navigate larger trades confidently. Consistency emerges from disciplined execution, not from chasing big wins, and understanding this is the single most important shift a trader can make in their mindset. Many traders enter the markets with the belief that success is defined by dramatic profits, by the exhilaration of hitting the jackpot on a single trade, or by the desire to prove themselves through rapid account growth. This belief is seductive because it appeals to the part of the mind that craves instant validation, instant recognition, and instant results. Yet the market does not reward desire or expectation. It only rewards behavior that aligns with probability, discipline, and objective observation. True consistency is built not by winning one huge trade, but by repeatedly executing a plan over and over with discipline and emotional neutrality. Disciplined execution is the bridge between knowledge and results. You can understand every chart pattern, every technical indicator, and every market theory, but without disciplined action, that knowledge remains theoretical. Discipline means showing up the same way every time, following your rules, adhering to your strategy, and doing so without being swayed by the emotional tides of fear, greed, hope, or frustration. Each trade, when approached with this mindset, becomes an opportunity to reinforce the habit of consistency rather than a chance to gamble for validation. The mind gradually learns to focus on process over outcome, and in that focus lies the essence of sustained success. Many traders fail because they confuse activity with productivity. They equate frequent trading, large positions, or high-risk moves with competence. In reality, without disciplined execution, such behavior leads to erratic results, emotional exhaustion, and a distorted sense of control. Consistency is not about being busy or aggressive. It is about precision, adherence, and measured responses to the opportunities the market presents. Each disciplined trade reinforces a feedback loop in which the mind learns to trust the process rather than the result. Over time, this trust reduces impulsive behavior and builds resilience to market fluctuations. Discipline also requires acceptance of uncertainty. The market is inherently unpredictable, and outcomes are probabilistic, not deterministic. Even the most carefully planned trades can fail. Traders who chase big wins often react emotionally to these failures, making larger bets in an attempt to compensate or attempting to control the uncontrollable. Disciplined execution, by contrast, recognizes that losses are a natural part of trading and that no single trade defines the journey. Consistency emerges not from avoiding losses, but from maintaining adherence to a structured approach regardless of short-term outcomes. It is in this environment of acceptance that the trader can act objectively and with confidence, free from the distortions of emotion. Another key element is the distinction between strategy and execution. A strategy may be robust, tested, and proven over time, but it produces results only when executed consistently. Traders often neglect this fact, believing that merely having a strategy is sufficient. They may follow it sporadically, skip rules when markets feel different, or adjust based on whims or temporary market sentiment. Disciplined execution ensures that the strategy is applied uniformly, and this uniformity is what generates the consistency in results. Without it, even a winning strategy becomes unreliable, because human emotion introduces variability into every decision. Building consistency also requires self-awareness. Traders must become intimately familiar with their own behavioral tendencies, emotional triggers, and habitual reactions. Are you prone to chasing trades when you feel excitement? Do you hesitate out of fear and miss opportunities? Do you let frustration dictate your next move after a loss? Recognizing these patterns is only the first step. Disciplined execution is the process of consciously managing and correcting them. By aligning your actions with your plan, regardless of internal turbulence, you cultivate the kind of steady behavior that produces long-term reliability. The more self-aware you become, the more you can act with precision and restraint. Small incremental wins play a crucial role in reinforcing discipline. Consistency is rarely born from a single monumental success. It grows from repeated, controlled, and calculated actions that slowly build confidence and reinforce positive habits. Each disciplined trade strengthens the mental pathways that support rational thinking, patience, and emotional neutrality. Traders who focus only on large wins often undermine these pathways as the pressure to succeed distorts judgment and encourages impulsive decision-making. By emphasizing disciplined execution over outcome, the trader nurtures a mindset that values the integrity of the process, creating the conditions for lasting success. Risk management is another critical component. Discipline and execution is inseparable from disciplined risk. Traders who chase big wins often disregard position sizing, leverage, and stop-loss placement in pursuit of rapid gains. This behavior not only jeopardizes capital, but also destabilizes the psychological foundation necessary for consistent performance. When discipline governs both strategy application and risk management, the trader maintains balance between potential reward and tolerable exposure. The result is a consistent approach that can weather losing streaks and capitalize on favorable conditions without collapsing under pressure. Patience is a natural byproduct of disciplined execution. The market does not conform to schedules or personal expectations. Opportunities arise in waves, often requiring the trader to wait and observe before acting. Those who chase big wins tend to act prematurely, forcing trades to fit a narrative or to satisfy impatience. Consistent execution teaches patience because it emphasizes alignment with the strategy and adherence to rules rather than impulsive gratification. Each moment of restraint reinforces the trader's capacity to act only when conditions are optimal, cultivating a rhythm of thoughtful engagement rather than reactionary behavior. Finally, disciplined execution creates a resilient mindset. Consistency is not just about mechanical adherence to rules, it is about developing the mental fortitude to maintain behavior under pressure, during uncertainty, and in the face of setbacks. The market will always present scenarios that challenge emotional equilibrium, but a trader who is trained through disciplined execution responds with stability rather than volatility. Confidence grows, not from ego, but from repeated proof that following a structured approach yields predictable results over time. Trading small helps internalize probabilities and detach from individual trade outcomes, and understanding this principle is essential for anyone who seeks sustainable success in the markets. Most traders enter the market with a focus on results. They want to win this trade, capture this move, or prove that they can outperform others. This attachment to outcomes, however, is a fundamental psychological trap. The market does not respond to desires, expectations, or attempts to control it. Every trade, no matter how carefully planned, is subject to probabilities, randomness, and conditions that cannot be fully predicted. Trading small allows the mind to absorb this truth without the emotional turbulence that comes with large stakes. It provides the space to experience the market as it is, rather than how one wishes it to be, and in doing so, it builds a deep understanding of probabilities and a detachment from individual outcomes. When you trade small, you start to perceive each trade as a sample in a broader experiment rather than as a life-defining event. Each position becomes an opportunity to observe market behavior, to test strategy execution, and to refine decision-making. With reduced financial consequence, you can focus on whether your rules are being applied correctly, whether your timing is precise, and whether your analysis is accurate. You begin to separate process from result. A losing trade no longer feels like a personal failure, it becomes data, information that informs the next decision. Similarly, a winning trade is no longer a cause for overconfidence. It simply confirms that your strategy can function as intended under the right conditions. Trading small reinforces this mindset, allowing probabilities to guide decisions instead of emotions. Internalizing probabilities is also about learning to accept variance. Even a well-tested system produces losses, and even a high probability setup can fail. Traders often overreact to these events, allowing one loss or one streak of losses to erode confidence and provoke impulsive decisions. When positions are small, the emotional impact of variance is minimized. You can observe that outcomes are random within a probabilistic framework and that the long-term expectation of your strategy is what matters most. This understanding is crucial because it shifts the trader's attention from being outcome-driven to being process-driven. Success becomes a function of consistently applying rules and probabilities over time, not of individual moments of luck or fear. Trading small also encourages detachment from ego. When financial consequences are limited, the trader is less likely to tie self-worth to performance. Many traders unconsciously define their identity by their wins or losses, and this creates immense pressure on each trade. Big losses provoke shame, while big wins trigger arrogance. Both extremes distort judgment and undermine consistency. Small positions reduce the psychological load, enabling the trader to act with greater objectivity. Decisions are made based on probability and alignment with the plan, rather than on the desire to protect ego or prove oneself. In this way, trading small is as much about mental conditioning as it is about risk management. Another significant benefit is the development of patience. Understanding probabilities requires the ability to wait for the right setups. Traders who chase large outcomes are often impatient. They feel compelled to be active constantly, to force trades that meet only partial criteria. This behavior leads to overtrading, suboptimal entries, and emotional stress. When trading small, impatience is less costly, and the trader can afford to observe, to wait, and to act only when probability aligns with their strategy. Each successful waiting period reinforces the connection between patience and favorable outcomes, gradually teaching the mind that alignment, not impulsivity, drives results. Trading small also provides a clear view of risk-reward dynamics. With lower stakes, you can analyze whether the potential return justifies the exposure without being emotionally compromised. You start to understand that each trade has a probability distribution of outcomes rather than a guaranteed result. Losses, small as they are, teach more than wins because they force reflection on execution, risk, and behavior. The repeated exposure to these controlled losses internalizes the lesson that no single outcome defines the system, and that over time, probability governs the result. This experiential learning is far more powerful than theoretical understanding or simulated trading because it engages both mind and emotion in a real but safe context. Emotional neutrality emerges naturally through trading small. When a trade is meaningful enough to require attention, but not threatening enough to provoke anxiety, the mind can operate without distortion. You learn to watch the market with clarity, to identify patterns without interference, and to act when conditions meet your criteria. The emotional extremes that typically accompany large positions, fear, hope, greed, and frustration, are muted, allowing the trader to observe probability in its pure form. Each trade becomes an opportunity to practice detachment while still experiencing the dynamics of the market firsthand. This balance between engagement and non-attachment is the essence of probabilistic thinking. Small trading also reinforces the habit of consistent process. Every trade, regardless of outcome, becomes a reinforcement of correct execution and adherence to strategy. You are rewarded not with financial gain, but with clarity, confidence, and knowledge. These intangible rewards are what ultimately sustain long-term profitability. By detaching from outcome and focusing on probabilities, traders begin to see patterns in their own behavior, where they act impulsively, where they hesitate unnecessarily, where their judgment is clouded by fear or hope. Identifying and correcting these patterns becomes possible only when the emotional pressure of large positions is removed. Over time, the lessons learned from trading small accumulate, producing a mindset capable of scaling. When a trader has internalized probabilities, developed patience, and cultivated detachment, they can increase size without introducing emotional chaos. The behaviors and habits established in the small environment carry over to larger positions because the foundation, the understanding of probabilities, and the ability to act without attachment is already in place. In this way, trading small is not a limitation but a preparatory stage, a psychological training ground that allows the mind to master itself before the money becomes meaningful. Scaling up becomes effortless once the mindset and emotional structure are built through small beginnings, and understanding this principle is vital for anyone seeking sustainable trading success. Many traders believe that increasing position size is primarily about capital and strategy, that if they have more money or a better system, they can automatically take larger trades and achieve bigger profits. While these factors matter, they are secondary. The real determinant of success at larger sizes is psychological readiness. Without a solid emotional foundation, larger positions magnify fear, greed, impatience, and doubt, often causing the very behaviors that lead to inconsistent results. Small beginnings, therefore, are not just about limiting risk, they are about constructing the mental and emotional framework necessary to manage larger exposure with clarity, confidence, and discipline. When traders start small, they create a low-pressure environment in which they can observe their own behavior. This is crucial because every trader has unconscious patterns that influence decision-making, patterns that are often invisible until stress amplifies them. For example, a trader might consistently hesitate before taking trades, exit winners too early, or hold losers too long. With small positions, the financial impact of these behaviors is minimal, which allows for clear observation and analysis. The trader can see their own tendencies without panic or defensiveness. Over time, these observations allow the individual to understand exactly how their mind reacts to different market scenarios, which is the foundation for scaling. If these behaviors are not identified and corrected at a small size, they are almost certain to be magnified at larger positions, producing emotional reactions that overwhelm rational thinking. Building this foundation requires more than simple observation, it requires deliberate practice. Every small trade is an opportunity to test execution, risk management, and emotional response. The trader learns how to follow their rules, manage stops, and take profits without letting fear or greed interfere. Each time they execute correctly, even with minimal financial consequences, they reinforce a pattern of disciplined behavior. Over time, these repeated experiences create what could be described as an internal architecture of consistency. This architecture is invisible but immensely powerful. It allows the mind to respond calmly under pressure, to trust in the plan rather than react to emotion, and to perceive opportunities objectively. When this structure is solid, increasing position size is no longer a leap into chaos, it is a natural extension of a system already operating smoothly. Scaling up also requires a mindset that understands and respects risk. Many traders see bigger positions as a path to faster wealth, ignoring the psychological cost of larger exposure. They underestimate how much fear and anxiety can distort decision-making. By starting small, the trader develops a realistic sense of what risk feels like and how to manage it. They learn how much emotional pressure a particular trade generates relative to their tolerance and how to maintain composure regardless of short-term outcomes. This skill, once developed, translates directly to larger trades. When the stakes increase, the trader's emotional framework can absorb the pressure without collapsing because the mental habits, emotional awareness, and process orientation were established in a safe environment. Another key aspect of scaling successfully is trust. Trust in oneself, trust in the strategy, and trust in the market. Small trading allows this trust to develop gradually. Each disciplined execution, each correct application of rules, and each observation of natural market variability reinforces the belief that the system works and that the trader can manage themselves within it. When trust is established, scaling becomes effortless because the trader no longer doubts their ability to follow their plan under increased pressure. Decisions are made based on data, probabilities, and strategy rather than emotion or ego. This trust is not theoretical, it is experiential, built through repeated practice in situations where the consequences were manageable, but the lessons were real. Scaling also benefits from the psychological habit of detachment. In small trading, the trader learns to separate the process from the outcome. Losses are accepted as part of the probabilistic nature of markets, and gains are viewed as confirmation of correct execution rather than validation of self-worth. This detachment is essential when exposure increases because larger positions amplify emotional response. If a trader has not developed the habit of detachment at a small size, the pressure of larger trades can easily trigger impulsive decisions, overtrading, or avoidance behaviors. By cultivating neutrality early, the mind is conditioned to respond rationally, to act according to plan, and to accept outcomes without emotional distortion. Patience and timing, cultivated through small beginnings, are also critical when scaling up. Small trades teach the trader to wait for optimal setups, to respect risk-reward relationships, and to act only when conditions align with their strategy. These skills do not change when position size increases, but their importance magnifies. Larger trades require the same patience and discipline, yet the stakes feel heavier. If these habits were not solidified with small positions, the emotional tension can cause the trader to rush, to over-leverage, or to deviate from their rules. Starting small allows these skills to become second nature so that when scaling occurs, the behavior remains consistent, rational, and controlled. Scaling is not simply a linear process, it is exponential in its psychological demands. A doubling of position size does not double financial risk, it often multiplies emotional risk. This is why many traders fail when attempting to grow their account quickly. By contrast, starting small allows the mind to adapt incrementally, learning how to absorb pressure, execute rules, and remain composed under real market conditions. The incremental approach builds a robust psychological resilience that acts as a buffer against the amplified stress of larger trades. Over time, this resilience becomes automatic, enabling the trader to act with the same clarity and discipline regardless of size. Finally, small beginnings create a cumulative foundation of confidence. Each successful experience, each disciplined trade, and each observation of personal behavior strengthens the trader's sense of capability. This confidence is not based on ego or luck, but on repeated proof that the trader can operate effectively under controlled conditions. When the time comes to scale up, this confidence allows the transition to feel natural rather than stressful. The trader approaches larger trades with the same mindset, emotional balance, and process orientation as they did with small trades, and this alignment between mental preparation and market action makes scaling almost effortless.